The content presented in this podcast is intended solely for general informational and educational purposes. Nothing herein constitutes or should be construed as financial, investment, legal, or tax advice. You should not act or rely on any information in this podcast without seeking the advice of a qualified financial professional. This audio/video podcast is an AI-generated product produced using Notebook LM. It automatically summarizes and synthesizes reports, analyses, and commentary originally published at reflectionsofreality.substack.com. All views, opinions, and analyses expressed are those of the original author and do not represent the views of any financial institution or regulator. Past performance is not indicative of future results. All investments involve risk, including possible loss of principal. All reflections of reality, all original content rights reserved. All right, with that out of the way, let's dive right into today's explainer, where we're going to unpack the July 18, 2026 Convergence brief. Our goal today is to see exactly where crowd predictions meet actual market reality. Here is our roadmap for today. First, the Convergence methodology. Second, Lens 1, poly-market odds. Third, Lens 2, market flow. Fourth, the Convergence verdict. And finally, strategic portfolio implications. Let's get right to it. Section 1, the Convergence methodology. Synthesizing data. So if you want to cut through the daily market noise, you really need a reliable framework. Think of it as synthesizing two completely different probability languages into one cohesive swing horizon view. We take Lens 1, which represents the forward-looking event probabilities pulled strictly from the polymarket macro monitor, and we contrast that with Lens 2. Lens 2 is the flow and breadth machinery derived from the weekly market intelligence brief. By putting the crowd's expectations on one side and actual institutional flow on the other, we can pinpoint exactly where they agree. And honestly, more importantly, we can identify where some severe mispricings exist. Moving to Section 2, Lens 1, poly-market odds, the crowd's predictions. Let's take a look at what the crowd is betting real capital on right now, starting with monetary policy. The polymarket crowd is pricing in a near zero, literally a 0.1% probability for a Fed cut in July. And looking ahead to September, only a 2.1% chance. This is a massive signal for a locked, higher-for-longer hawkish anchor. Our sources note that this firmly anchors the 10-year yield around 4.55% and supports the DXY above 100.78. Basically, the crowd firmly believes the Fed is completely frozen. Now here's where it gets really fascinating. Let's talk geopolitical risk. Polymarket shows a 27.5% implied probability of a U.S. invasion of Iran before 2027. On top of that, there's a 5% chance priced in for the loss of Karg Island by July 31st. We're looking at a severe tail risk that is completely mispriced by crude oil's current zero-war premium, especially with Brent sitting at $88.10 and WTI at $82.47. To put that into perspective, these polymarket odds are actually 3 to 5 times above the legacy defense consensus. And then we have NVIDIA. Right now, it's sitting at a 49.5% coin flip for market cap leadership. This is the single biggest binary event for equity index structure today, and it's simultaneously capping the NDX at 28,859. So wrapping up Lens 1, we are looking at a crowd that is highly hawkish on rates, but incredibly bullish on geopolitical risk. All right, Section 3, Lens 2, market flow, reading the tape. We know what the crowd is predicting, but what is the tape actually doing? Let's check out valuation using the Market Valuation Index, or MVI. As a quick refresher based on the framework, MVI measures how attractive stocks are versus bonds after adjusting for the business cycle. So it's showing the cyclical equity risk premium, not just raw valuation. High or positive readings mean stocks are cheap and rewarding, while deep negative readings mean they are expensive and risky relative to yields. Currently, SPY sits at negative 0.47, QQQ is at negative 0.53, and small caps, they are lagging significantly at a deep negative 1.10. That's a very clear risk-off signal for the small cap segment. Next up is our health indicator. This measures market breadth based on a machine learning flow model, where high means broad trend confirmation and low signals divergence risk. Right now, health sits in bearish territory at 43.5%. So even though medium-term options positioning, or the frontier, is bullish at 57.0%, that low health reading tells us this bullishness is simply not being confirmed yet by broad market participation. Let's look at rotation states to see the actual flow structure. Accumulation means institutional buying or inflow. Rotation out is fading momentum and profit-taking.
Liquidation is institutional selling or outflow. Right now, across large caps, we're seeing heavily defensive behavior. Accumulation is at a really weak 6.6%. Compare that to a dominant 17.5% in rotation out. That tells us institutions are clearly fading momentum in trimming their positions, rather than aggressively adding exposure.
But despite that weak breadth, the weekly report's macro seasons confirm that reflation is still the dominant regime, sitting at 68.8%. Our source notes that this specific backdrop of growth and inflation historically favors energy and cyclicals. We also see Goldilocks acting as a secondary supportive theme at 59.0%. Moving to Section 4, the Convergence Verdict. Signal meets noise. This is where we bring it all together to figure out where the polymarket odds and the weekly report flow completely align, and they definitively agree on two structural themes. First, a higher for longer monetary regime. Lens 1 prices near zero cut odds, and Lens 2 shows liquidation rising in duration assets. They completely agree. Second, there is a massive mispricing in energy and commodities. Polymarket prices extreme Iran invasion odds, while the tape shows the energy sector, XLE, hitting a triple play accumulation signal. Again, full agreement. This integrated picture reveals what the brief calls the health versus price paradox. We are in this sort of narrow ledge rally right now. Index levels are holding near their highs because of energy and large caps being supported by that reflation regime we just talked about. But under the hood, the majority of names are rotating out, and breadth is bearish. The tape is basically telling us the coronation is real, but half the kingdom didn't even bother to show up.
Finally, Section 5, Strategic Portfolio Implications, Swing Horizon Actions.
So how does this synthesis actually dictate your positioning? Well, the swing prescription is exceptionally clear. Number 1, let your winners breathe, where both lenses align, like holding Goldman Sachs and Union Pacific. On the flip side, maintain strict daily stop discipline on MAP-penalized positions like Eli Lilly and DHI. And the golden rule here? You only deploy fresh capital where Lens 1 and Lens 2 point in the exact same direction, and you demand first-week confirmation for any new entries. As we keep an eye on the tape, the ultimate question remains. Will broad market participation finally show up to push health over 50% and validate the polymarket crowd? Or is this narrow edge rally just destined to collapse under the weight of systemic profit-taking? You'll have to watch the convergence of these two lenses to find out. Thanks for joining this explainer, and stay sharp out there.